Hi, welcome to Market Watch. I'm Liam Dan. Today we are discussing recessions. Are we in one? Are we headed for one? And how do markets react around a recession? With me as always to discuss, I have PiFund's CEO and founder, Mike Taylor. Hi, Mike.
Hi, Liam. How are you?
Good, thanks. Look, gloomy topic, sort of, but we all know we are going through a sort of a downward economic cycle. Are we in recession?
Well, traditionally, we've always said that a recession is defined as 2 consecutive quarters of negative GDP growth, real GDP growth, it is. And actually, just in the US, just last week, we came out and it looks like they've got 2 negative quarters of GDP growth. So normally, that's what we would say is a recession. However, in the States, they haven't actually called a recession yet because there are a number of other factors which we would look at to kind of determine what a recession might be. And so, you typically look at things like whether you got falling bond yields. Yes, we do have that at the moment. Where's inflation? Well, inflation is not really falling, so that would probably indicate we haven't quite ended the recession yet, because typically recessions are very deflationary for an economic environment. We listen to the Fed, and the Fed is always probably last to call a recession because they don't want to affect consumer confidence, of course, by telling people we're already in one. So they're not calling it yet. Investor sentiment and consumer sentiment isn't great. It's sort of around levels where historically it has indicated we've been in a recession. But the one thing which is probably leading to us not to call a recession, or other economists to call a recession, is that unemployment. So unemployment has not yet started to rise. We still know that it's very hard to find skilled labor anywhere in the world, really. So it's pretty hard to have a recession when you've got full employment in a tight labor market.
Yeah, I mean, having a job makes all the difference. Inflation is no fun, but I guess you can manage your way through and still make economic choices as long as you've got a job and income. And recessions tend to be marked by large-scale job losses and people having, really withdrawing from the economy.
Exactly. And we also need to remember that there was a significant amount of excess savings that were built up during the pandemic from stimulus provided by governments, and also people just not spending because they didn't go out. So whilst consumers might be drawing into their sort of household savings at the moment, there's still quite a lot that's sort of available for them to use. We also know that house prices have gone up, and so consumers have generally felt wealthier and they've got a bigger asset base to draw on. So yeah, there's a number of factors which would suggest that we may not be in a recession despite everyone calling it.
Yeah. Okay. Well, even if we say, look, we're not in recession yet, there's no doubt that central banks are trying to remove demand from the economy. Interest rates are going up. Do you think we are headed for a recession?
Well, certainly there's a number of indicators and data points which would suggest that we are going to head into recession, particularly around the interest rate point. So the rate in which interest rates have risen is, historically extremely high, and often it takes a couple of months, maybe 6 months, for those rate hikes to be felt in the real economy. So if you look at New Zealand, where we now have our mortgage rates up around 5 or 6%, it might move there, but it takes time, of course, for people to roll off their fixed rates. And then it's not until those mortgages get rolled over that people go, I'm just moving from a 3 to 6% mortgage. Now I've got to adjust my consumption spending habits. So I think that part is still to bite, and that might be later in the year.
Sure. So if we assume that, and even if we optimistically assume it's a fairly managed slowdown in the economy, it's not necessarily the deepest recession, it doesn't feel like sort of a 2008 scenario, how do you feel about markets and how markets react around recessions? I mean, how worried should we be about further losses on the markets as we head into recession?
So I went back and had a look at all the declines for the S&P 500 sort of over the last 50 years. And the average decline for a recession is around about 30%. Now, if you have a very mild recession, typically stock market declines are sort of, 20 to 25%. And that's what we've already had. I think the S&P was down about 23% in mid-June. So if we were going to have a mild recession, we could probably say, you know what, market might be done, and we can talk a bit more about how the market's forward looking. But if the recession were to turn nasty and were to look similar to, like a recession in this 1973 or in 2008, then we would expect further and significant losses for equity prices.
Okay, a big part of this is our sentiment, investor sentiment, consumer sentiment. I mean, could it be a bit different this time in the sense that, I think people understand that the slowdown in the economy is part of the cure, I guess, for high inflation, the supply side problems. Are people braced a bit for some of this slowdown over the coming months and year?
Yeah, I mean, there's a certain belief out there that a recession is kind of self-fulfilling, right? As that bad news begets more bad news, and if you feel bad about things, you'll react in a certain way. And so if you ask someone on the street how they feel about the economy, they're probably going to feel quite downbeat from a consumer perspective because, prices are rising, and there's less money in the wallet than there was a year ago. And house prices have come down a little bit and stock prices are down. So at the moment, whether you're an investor or whether you're a consumer, you're not feeling that great.
So, yeah, as you mentioned, one of the key things really with recession can be employment. Does that mean you kind of keep an increasingly close watch on that labour market data?
Yeah, that's probably one of the most important things to look at in the coming months to determine whether if you're a stock market investor, whether the market has already bottomed or whether it's going to go further. Because if the unemployment rate was to rise by, say, more than 1%, I think that would probably be quite negative for the economy and also for stock prices. So if there's a small marginal movement, I think that's fine. But once the unemployment rate starts to lift beyond a 1% change, typically that leads to a reasonably protracted and deep recession.
So where does all that leave you, I guess, when you're assessing your strategy and outlook for the next 6 months, year? I mean, I guess we're at a very sensitive point around the data and just getting a sense of, how deep this might go.
I think, Fed Chairman Powell said it correctly when we need to kind of look at this meeting by meeting, is that we don't really know where the data is going to go or how things are going to react in the future. I mean, could there be a ceasefire in the Ukraine, for example? What would that do for oil prices? Some of the commodity prices like wheat, grain and corn, they've come off significantly, as has things like copper. So that's all helpful for the inflation story. Container shipping prices are coming down. So there are some positive data points out there. But I just think we need a few more to determine, where this is going to go. It's just too early at the moment to just say, all right, yeah, bottoms in equity prices. We just need to see things, how they play out in the next couple of months.
Yeah, so markets do like to be at the front end of things, to look forward, but I guess there is a sense, and we've talked about this before, that there's a second half, if you like, to this economic cycle that we still kind of have to go through and get through over the next year.
Correct. I think we've had the initial pain from the sharp rise in interest rates, and then the next point of pain will be coming from how people react to higher interest rates and how that affects their spending patterns and what that does for employment or unemployment, probably between now and December. So that's the second iteration of this market leg down. If that's relatively benign and mild, then markets are probably put in a low. If it's a bit nasty, then markets will probably go lower from here. One interesting thing that I've noted is that the bond market seems to have determined that yields have peaked, which is quite interesting because, they always say the bond market is the smartest. And so in mid-June, the US 10-year gets to 3.5%. Today, it's around 2.6. That's a significant pullback. And it's the bond market saying that, well, we think interest rates have peaked and that the economy is slowing. Not yet kind of recessionary slowing, but has slowed.
So that would be slightly heartening as a base case scenario. I guess we just have to stay alert to risks that as you say, things like the war in Ukraine, if we saw petrol prices spike and inflation get worse, then we might have to have even higher interest rates, and that would be problematic. Okay, Mike, well, that's probably a good place to wrap it up. And just, I guess, to sum up, we're talking about the base case not looking horrendous here, but really important to keep an eye on those global geopolitical events and what's happening in employment markets.
Absolutely. Those are two most important things to look at for the rest of the year.
That's great, Mike. We'll leave it there. Cheers.
Thanks.